Silver trading is paused tonight. But before futures reopen Sunday evening, one headline from the Middle East, Washington, or a critical shipping lane could completely reshape Monday morning's market. Financial television is quiet for the weekend, which means most people will wake up reacting after the move already happens. You do not want to be in that group. You want the framework before the price shock arrives. Right now, silver traders are staring at one of the tightest pressure zones of the year. Friday closed with silver near $75 per ounce after another weak finish into the bell. Futures opened higher earlier in the week, drifted lower through multiple sessions, and ended close to the weekly bottom. On the surface, that looks calm. It is not calm. It is stored pressure. For days, prices moved inside an unusually narrow channel. Average daily movement barely changed, and many analysts frame that as stability, but compressed markets are often the loudest warning signs. A spring under tension does not look dangerous until it releases. And silver, right now, is balancing on three unresolved global developments capable of triggering violent price action in either direction. So what exactly are those developments? And more importantly, what could each outcome mean for your portfolio by Monday morning? The first and biggest variable is the Iran negotiation process. Reports from Washington suggested progress late Friday, but officials stopped short of confirming a completed agreement. Meanwhile, regional diplomats met in Pakistan to discuss possible pathways toward reducing military escalation. Earlier in the week, optimism surrounding negotiations pushed crude oil sharply lower in a single session. Tanker traffic to the Strait of Hormuz also increased noticeably, signaling that markets briefly believed tensions could cool. Then sentiment shifted again. By Friday afternoon, energy traders began questioning whether a breakthrough was actually close. Oil recovered strongly. Silver surrendered mid-week gains, and investors headed into the weekend without clarity. That uncertainty is the reason Monday's opening price could become one of the most volatile starts in months. Now let us break down the three possible scenarios. Scenario 1. A confirmed diplomatic agreement arrives before futures reopen Sunday night. If both sides publicly signal progress or announce terms, silver could react instantly the moment electronic trading begins. We already saw what rumors alone did earlier this month. This time, confirmation would carry much more weight because markets would no longer be pricing hope. They would be pricing a structural change in inflation expectations. Oil would likely fall sharply toward lower levels, and the inflation pressure created by energy costs would begin unwinding immediately in traders' minds. And silver, which has been fighting against rising real yields for weeks, suddenly gets relief. Remember this, markets do not wait for official inflation reports before moving. They anticipate. If investors believe the energy shock is fading, silver could surge before economic data ever confirms it. In that environment, a rapid move back above $80 becomes realistic. Traders would immediately begin repricing expectations around the next Federal Reserve meeting. Current projections favor holding rates steady, with lingering fears of future hikes because inflation remains elevated. But if oil collapses lower, the entire conversation changes. The central bank outlook changes with it. Markets move first. Explanations arrive later. Now ask yourself something. What happens when industrial demand stays strong while monetary pressure finally weakens? That leads directly into the bullish thesis many institutional investors still believe in. But before we get there, consider scenario 2. If negotiations fail this weekend, if one side rejects terms publicly or military tensions escalate again, the opposite reaction becomes possible very quickly. Oil could spike back above recent highs. Inflation fears would intensify immediately. Traders would assume the Federal Reserve stays aggressive longer than expected, and silver, already struggling under elevated yields, could retest major support zones within days. That downside scenario matters because many investors are only focusing on the long-term bullish narrative while ignoring short-term macro pressure. Elevated energy prices raise transportation costs, manufacturing expenses, and inflation expectations simultaneously. That combination strengthens the dollar and raises bond yields, both of which create headwinds for precious metals. So yes, silver has powerful structural demand underneath it, but in the short run, macroeconomic fear can overpower even strong fundamentals. And now we arrive at scenario 3, which may actually be the most likely outcome of all. Nothing definitive happens this weekend. No breakthrough, no collapse, just more uncertainty. If that occurs, Monday probably begins where Friday ended. Silver stuck in the middle range, oil elevated, rate fears still active, and traders waiting for the next catalyst. That next catalyst arrives through economic data later. In the week, especially GDP numbers and labor market reports. Those releases will shape expectations about whether the economy is slowing, while inflation stays stubbornly high. And that is where the deeper silver story begins. So, because silver today is trapped between two competing forces, understanding those forces is what separates emotional traders from informed investors. Silver operates through two major demand drivers. The first is monetary demand. The second is industrial demand. Under healthy economic conditions, both work together. Monetary demand rises when investors seek protection from inflation, falling currencies, or declining confidence in fiat systems. Industrial demand rises because silver remains critical for solar panels, electronics, electric vehicles, data centers, and advanced technology manufacturing. When those two engines align, silver can move explosively higher. That alignment helped fuel the massive rally from early 2025 into the beginning of this year. Prices multiplied because investment demand and industrial consumption strengthened. Simultaneously, then, the geopolitical crisis disrupted the equation. When oil prices exploded higher after shipping routes faced threats earlier this year, inflation expectations surged. Higher inflation forced traders to abandon hopes for rapid rate cuts. Treasury yields climbed. Real yields strengthened. Suddenly, holding bonds became more attractive relative to metals that weakened silver's monetary appeal. So while industrial demand remained alive, the monetary side of the equation began pushing against price growth instead of supporting it. That is why silver repeatedly struggled near key resistance levels despite ongoing supply shortages. And those shortages are very real. Global silver deficits have now continued for multiple consecutive years. Mine production growth remains limited because most silver is produced as a secondary output from other mining operations. Companies cannot simply double silver extraction overnight, even if prices surge. Supply chains remain tight, industrial consumption remains historically strong, and refining restrictions from major exporting nations continue affecting global availability. Meanwhile, paper leverage in futures markets remains extraordinarily elevated relative to available physical metal. That imbalance matters more than many investors realize. If strong investment demand returns suddenly, while physical inventories stay constrained, price discovery can accelerate violently. This is the core bullish argument. Industrial demand never disappeared. Monetary demand simply weakened because inflation fears forced central banks into a tougher position. If geopolitical stress fades and inflation expectations cool, monetary demand can restart while industrial demand continues pushing underneath. That combination changes everything. It turns silver from a metal surviving on one engine into a metal accelerating with two engines firing simultaneously. And historically, those moments have produced some of silver's fastest rallies ever recorded. Now, think carefully about this question. If supply deficits persist, while both demand engines reactivate together, how quickly could pricing dynamics shift? Scarcity always matters eventually. Institutional forecasts still point dramatically higher over the longer term. Some analysts project major upside based on historical gold-to-silver ratios compressing during strong bull markets. Others believe expanding industrial dependence alone justifies significantly higher valuations over time. None of those projections assume permanent geopolitical chaos. That distinction is critical because if markets begin believing current energy disruptions are temporary instead of permanent, capital flows can reverse with stunning speed. Now let us discuss the inflation expectations data released Friday because this piece is not getting enough attention. Consumer inflation expectations softened modestly compared with previous readings. The decline was not enormous, but direction matters more than size at this stage. Why? Because inflation psychology influences everything from wage negotiations to consumer spending habits to Federal Reserve policy expectations. When households expect inflation to keep rising endlessly, central banks become more aggressive. When expectations stabilize, policymakers gain breathing room. So even a small decline in long-term inflation expectations matters for silver traders watching rate projections closely. If upcoming data confirms that inflation expectations are cooling instead of accelerating, silver gains breathing room. If future reports show inflation psychology worsening again, pressure on metals likely intensifies. That is why sophisticated traders are watching both geopolitical developments and consumer sentiment simultaneously heading into Monday. Together, those factors will heavily influence futures positioning the moment electronic trading resumes. Now, let us widen the lens further. Gold prices remain historically elevated despite volatility. Many major banks still maintain aggressive long-term targets for gold itself. If those targets eventually materialize, while the gold-to-silver ratio compresses back toward historic bull Market ranges, silver's implied valuation climbs dramatically. This is not complicated mathematics. It is ratio compression combined with rising gold prices. During previous precious metals bull markets, silver often outperformed gold because the ratio tightened aggressively once. Momentum accelerated. That is why so many long-term silver investors remain confident despite recent turbulence. They are not only betting on inflation protection, they are also betting on industrial scarcity, renewable energy expansion, technology infrastructure growth, and future monetary easing eventually returning at the same time. But timing matters. And timing right now depends heavily on macroeconomic data arriving over the next several weeks. GDP releases, labor market numbers, inflation readings, and Federal Reserve projections will all shape expectations around stagflation risk. Weak growth combined with stubborn inflation creates a nightmare scenario for policymakers. It traps central banks between supporting economic activity and controlling rising prices. Silver sits directly in the middle of that conflict. If growth deteriorates while inflation cools, metals gain relief. If inflation remains hot while growth weakens, yields can stay elevated longer, keeping pressure on silver despite industrial strength. That is why the next Federal Reserve meeting matters enormously. Markets will study every projection, every statement, and every voting shift for clues about future policy direction. Even subtle language changes can move metals sharply. If policymakers hint that cuts may eventually return, silver benefits immediately. If officials signal continued concern about inflation persistence, resistance levels could remain difficult to break through this summer. Now let me leave you with the bigger picture. The question is not whether silver can swing sharply Monday morning. It absolutely can. The real question is whether you understand the forces creating that volatility before the opening bell arrives. Because beneath the headlines, silver still represents something structurally important. It remains deeply tied to electrification, renewable infrastructure, artificial intelligence expansion, and global industrial modernization. At the same time, it remains a monetary asset capable of attracting capital during periods of currency instability and declining confidence in financial systems. That dual identity is why silver becomes so explosive during certain economic cycles. Right now, one side of that identity is partially constrained by inflation fears and elevated yields, but the industrial foundation underneath the market never vanished. It kept building quietly while prices consolidated. And history shows that compressed markets often produce their largest moves after long periods of frustration. Every geopolitical crisis eventually resolves. Every energy shock eventually normalizes. Markets that spend months trapped inside uncertainty eventually choose direction. The only unknown is timing. This weekend may not deliver the final answer, but it could deliver the catalyst that changes expectations very quickly. Watch developments surrounding Middle East negotiations, watch energy markets Sunday night, and watch inflation expectations and economic data this week. Those signals together will likely determine whether silver breaks upward, retests support, or continues consolidating temporarily. And if you found this breakdown useful, make sure you like the video and subscribe to Winds of Thought because we are tracking every major shift in the silver market as it unfolds in real time. Share this video with someone holding silver right now because Monday's opening move could catch millions of investors completely unprepared. Stay alert, stay informed, and be ready before the market decides for everyone else. Until next time, keep your eyes on the signals nobody else notices. First, the next move may already be forming tonight. While most investors are sleeping, watch carefully. Futures never wait for comfort. Pressure builds silently before history notices it. The smart money studies conditions early, not afterward. This week could become one of those moments traders remember for years ahead worldwide.